Imagine a world where the very bedrock of global finance is undergoing an intentional strategic overhaul, almost silently, directed by, well, maybe one powerful figure. Today, we're taking a deep dive into an audacious and frankly controversial perspective on U.S. Treasury Secretary Scott Bessent. Specifically, his alleged strategy to boldly reassert American financial dominance and the unexpected tool he's supposedly wielding, stablecoins.
Yeah, and our mission for this deep dive is really to extract the most important insights from this pretty intriguing analysis by Arthur Hayes. We'll try to explain these complex financial maneuvers in clear, approachable language so you can truly grasp what might be at stake for the global economy, maybe your own financial future, and, the evolving landscape of digital assets. We'll explore how this vision could impact everything from international banking to just your everyday ability to send money across borders. It really sheds light on the future that might be unfolding right now.
Exactly. And our primary source for this deep dive is, as you said, that striking and highly opinionated essay by Arthur Hayes, provocatively titled Buffalo Bill.
Yeah.
It offers a very distinct, very strong viewpoint on these developments, one that we felt was, well, absolutely essential to explore. So let's unpack what Arthur Hayes calls the Buffalo Bill thesis. The central figure here is U.S. Treasury Secretary Scott Bessent, and the author Hayes has quite controversially given him this nickname, Buffalo Bill, suggesting Bessent is preparing to, let's say, exterminate key elements of the global financial system as we know it. It's a bold assertion right from the start.
It really is. And what's particularly insightful, I think, is how Hayes connects Bessent's perceived actions to the historical concept of Pax Americana. Specifically its reliance on the U.S. dollar as the undisputed global reserve currency. Hayes argues this control has sort of evolved into a system where nations are bound by a form of modern debt servitude. That's his framing. He even goes on to claim that this long-standing system is now facing unprecedented vulnerability, partly due to the rise of AI, artificial intelligence, which he believes will lead to widespread unemployment and disrupt the traditional, debt-driven economic model. This, he argues, creates an urgent need for the U.S. to shore up its financial foundation.
Right. And according to Hayes, Bessent sees two significant sort of interlocking problems with the current financial order. First, Hayes believes Bessent is clueless, his word, about the sheer scale and complex financing of the vast euro-dollar system. That's the trillions of U.S. dollars held outside U.S. banks. And second, and this is where it gets really interesting, these massive euro-dollar deposits aren't buying up U.S. Treasury debt securities at the rate Bessent supposedly wants or needs. They're just not flowing into the assets he needs to finance America's expanding national debt. Hayes uses very blunt language there, suggesting a real lack of demand.
Yeah, and if we connect this to the bigger picture, this perspective does align with broader de-dollarization trends we hear about. Hayes contends these trends really accelerated post-2008 with what he calls QE infinity quantitative easing, which, for those unfamiliar, is basically large-scale central bank money printing to stimulate the economy. This era, Hayes argues, prompted global central banks to significantly increase their gold reserves, kind of signaling a growing distrust in the U.S. government's financial policies, right? The numbers Hayes cites are indeed stark. He claims treasuries have lost almost 80% of their value versus gold since 2009. That reflects a deep-seated shift in investor confidence, if true.
Okay, so with these challenges in mind, weakening demand for U.S. debt, a huge euro-dollar system operating outside direct U.S. control, what does Hayes believe is Bessent's audacious solution? He claims it's stablecoins. The U.S. financial empire will strategically, quote, support select issuers as they hoover up euro-dollar and global south retail deposits. The core insight here isn't just that stablecoins are being adopted, it's about their strategic repurposing, turning them into a sophisticated instrument for national economic policy, basically a crypto innovation becoming a geopolitical lever. Okay, let's unpack what an acceptable stablecoin looks like within this proposed new financial architecture. The author vividly describes it as being analogous to a narrow bank. Think of a narrow bank as a highly specialized financial entity that's only allowed to hold the safest, most liquid assets. No risky loans, no complex investments. That's our analogy for how Hayes views these new stablecoins.
Exactly. And the mechanism behind these acceptable stablecoins is quite precise, according to Hayes. For creation, an authorized participant, let's say a big financial institution, wires traditional U.S. dollars to the stablecoin issuer. In turn, the issuer creates an equal number of digital stablecoin units, say USDT. Crucially, those dollars they receive are then invested exclusively in risk-free U.S. Treasury bills, short-term government debt, with maturities less than 1 year. Now, the strategic advantage for the issuer comes from the net interest margin, or NIM. While the stablecoin itself usually pays no interest to you, the holder, the issuer, earns a yield from those T-bills. Roughly the current Fed funds rate, maybe 4.25% to 4.50% right now. That spread is pure profit for them. Then for redemption, the process just reverses. The issuer sells T-bills, sends dollars back to the participant, and effectively burns or destroys the stablecoins.
And to ensure these stablecoins are truly acceptable and trustworthy, Hayes argues Besant will impose strict legal requirements. These issuers, he claims, must hold their dollars only in chartered U.S. banks or, as we just heard, in those short-term T-bills. There's to be no funky stuff, as Hayes puts it, no weird investments. This singular focus on U.S. government-guaranteed bank deposits and T-bills is designed to make these stablecoin deposits seem risk-free in nominal dollar terms, backed ultimately by the full faith and credit of the U.S. government. Now let's dive into Hayes's most provocative claim, the so-called extermination of the Eurodollar system. Just for context, the Eurodollar market started way back in the 1950s and 60s, primarily as a way to get around U.S. capital controls and sanctions and to help bank non-U.S. trade. It's grown into this colossal system with an estimated, $10 to $13 trillion sloshing around in various non-U.S. bank branches today. It's a huge, largely unregulated pool of dollar liquidity outside the U.S.
Right. And what's fascinating here is Hayes's controversial claim that, historically, the U.S. Fed and Treasury implicitly backed these Eurodollar institutions. Essentially, during crises, the U.S. would kind of step in, giving depositors an unstated but understood guarantee, a safety net. But now, the author suggests Besant will actively remove this implicit guarantee, potentially declaring publicly that there will be no help for non-U.S. bank branches in a future crisis. This would be a massive, highly disruptive shift in long-standing policy, moving from implicit support to explicit denial. It's designed, Hayes argues, to create a clear incentive for capital flight.
And the intended consequence of such a dramatic move, it's pretty stark. Eurodollar depositors, acting purely in their own financial self-interest, would rapidly shift their funds out of those now risky Eurodollar accounts and into these supposedly risk-free dollar-pegged stablecoins like USDT. It's a calculated play, according to Hayes, to redirect massive capital flows.
Okay, but while this strategy might look straightforward on paper, create risk here, safety there, and the money moves, it definitely raises some important questions. What about the potential, maybe unforeseen, systemic risks of deliberately debanking such a huge, established global financial system? Could that cause widespread instability? Maybe create entirely new vulnerabilities we haven't thought of? Or what if it just pushes these massive dollar flows into less transparent, maybe less regulated channels if they don't all go into U.S.-approved stablecoins? This aggressive move, framed by Hayes as a solution for U.S. debt, could easily trigger significant global financial backlashes, or even speed up de-dollarization efforts in other ways if foreign players see it as, weaponizing the dollar. You have to ask, right, could the cure be worse than the disease, or just create a whole new set of complex problems?
That's a really important counterpoint to consider. Despite those potential issues, though, Hayes seems convinced about the ultimate outcome. He believes stablecoin issuers would face this massive influx, that $10 to $13 trillion from the Eurodollar system. They would become huge, price-insensitive buyers of T-bills, meaning they just have to buy them, regardless of the yield, potentially giving Besant an unprecedented level of control over the front end of the yield curve. The interest rates on short-term government borrowing, which affects everything from consumer loans to business investment, it's a direct, powerful way to finance U.S. debt on the Treasury's own terms. Okay, let's broaden our lens now and shift focus a bit to the global south. The author argues there's this vast underbanked population in these regions that desperately wants access to positively yielding dollar accounts. These individuals, these businesses, he claims, are eager to escape what he bluntly calls shitty currencies. Local currencies plagued by high inflation and instability.
Yeah, and this is where Hayes introduces a really bold prediction, using a potent metaphor. He claims U.S. social media companies will be the Trojan horse that ultimately undermines foreign central banks' control over their citizens' money supply. The idea is that these platforms, which everyone uses already, can subtly introduce a new financial system, one that bypasses traditional local banking infrastructure, much like, the legendary horse smuggled soldiers into Troy. Sneaky.
Right. And to illustrate this, Hayes offers a compelling fictional example. Fernando in the rural Philippines, running a click farm. His clients are all overseas, making traditional payments slow, difficult, expensive. But now maybe WhatsApp rolls out a crypto wallet. Suddenly, Fernando can seamlessly send and receive USDT with his international clients. His clients are happy, they ditch the inefficient local banks Hayes describes, but this completely disintermediates the local Filipino banking system, shifting financial activity onto US-controlled rails.
And this raises a critical question for foreign central banks, doesn't it? What happens when they effectively lose control of their domestic money supply, with citizens moving straight into dollar-denominated stablecoins? Hayes suggests they'd have limited recourse against powerful U.S. tech giants like Meta, especially if these companies operate with, as he puts it, the blessing of the Trump administration to roll out stablecoin functionality globally. Hayes even goes further, suggesting the U.S. could use sanctions against foreign leaders who resist this shift, basically coercing compliance. It paints a picture of financial diplomacy turning into, well, economic warfare.
And the potential scale of this, according to Hayes, is just staggering. He provides this massive total addressable market, or TAM, estimate for potential stablecoin deposits. He projects $4 trillion from BRICS nations, excluding China, plus another $16.74 trillion from what he controversially calls Euro-poreans. People he believes will suffer from a splintering Eurozone, lose faith in the euro, and seek refuge in dollar assets. You add that up, that's a grand total of $34 trillion that Hayes envisions flowing into these stablecoins. That's huge.
It's an enormous number.
So let's explore how Hayes predicts this massive influx of stablecoins would drive usage and innovation in decentralized finance, or DeFi. It starts with the simple concept of staking stablecoins for yield, effectively transforming them from just static digital dollars into interest-bearing assets, making them much more attractive to hold.
Right. And Hayes specifically highlights 3 DeFi projects he sees as primary beneficiaries of this shift. First, Ether.fi Cash, ETHFi. This offers a Visa-powered stablecoin spending card for global users, positioning itself as a kind of financial supermarket for the unbanked and underbanked. Hayes, who, full disclosure, advises Ether.fi, projects substantial growth here, seeing it as a key entry point for new users into this ecosystem. The insight being that platforms like this aim to make digital dollar access and spending as easy as using a regular bank card, but globally and without the old overhead.
Okay, so that's one. What's the second?
Second, there's Athena. This aims to offer higher yielding opportunities. How? By lending to speculators via derivatives using what's known as a cash and carry strategy, which basically involves buying an asset and selling a futures contract on it simultaneously, trying to profit from the spread while hedging risk. Its USD stablecoin is described by Hayes, who's also a founding advisor here, as the fastest growing. He projects it surpass Circle's USDC, and crucially, offering staked USD yields potentially double the current Fed funds rate, so much higher yield.
Interesting. And the third project Hayes singles out.
That's Hyperliquid, HYPE. It's a decentralized derivatives and spot exchange, DASX. And Hayes makes a really bold prediction here. He says it will become the largest crypto exchange of any type, eventually surpassing even centralized giants like Binance.
Oh, wow.
Yeah, he projects astonishing growth, mainly driven by that massive, potential $10 trillion stablecoin circulation he anticipates, making Hyperliquid a central hub for digital asset trading in this new world.
And Hayes' conviction seems pretty strong. He views this entire scenario as, quote, a once-in-a-century change of the global monetary architecture. He believes this fundamental reshaping will lead to an epic bull market in these specific DeFi pillars he mentioned.
Exactly. The real insight here is that he sees these projects not just as standalone cool tech, but as integral parts of a new U.S.-centric financial system, a system that leverages stablecoins to finance U.S. debt and extend its influence globally. It's all connected in his view.
Okay, let's bring it all back then to what Hayes terms the reign of Buffalo Bill Besson and the forecasted outcomes of this alleged strategy. The author reiterates his belief that Besson's aggressive actions are inextricably tied to the U.S. government's widening deficits and, critically, specific political goals, namely financing what Hayes bluntly describes as populist spending free shit to secure future elections.
Right. And to achieve these ends, Hayes predicts Besson will wield the sanctions cudgel widely and violently, his words again, to force capital into these stablecoins. He also expects Besson to, quote, deputize the tech giants like Zuckerberg and Musk to push dollar-pegged stablecoins globally, even if local regulators don't want them. Hayes then forecasts a series of news headlines that he believes will confirm his thesis is playing out.
What kind of headlines?
Things like Butterquala calls for more oversight of the offshore USD market, the Eurodollars, tying central bank dollar swap lines. Emergency dollar access to foreign countries opening their digital markets for U.S. tech firms. New regulations requiring stablecoin issuers to hold their dollar reserves only in U.S. banks or T-bills. Maybe encouragement for stablecoin issuers to list on U.S. stock markets, bringing them further into the fold. U.S. big tech firms adding crypto wallets to their social media apps, like that WhatsApp example. and just generally positive statements from the Trump administration, assuming he's in power, about stablecoins.
Hmm. What's particularly interesting is that Hayes then introduces his own new stablecoin infrastructure project, Codex, which he advises. He predicts it will be the best performing token from its upcoming token generation event, or TGE. Hayes describes its potential to disintermediate traditional banking for businesses and extend credit to underserved small and medium-sized enterprises, effectively acting as the first real crypto bank by leveraging this whole new stablecoin architecture he envisions.
Yeah, and Hayes sort of concludes that as government deficits keep widening and, Pax Americana's financial dominance faces challenges, Besant will inevitably need to stuff more and more debt down the throat of the market.
Mhm.
And since the market, in Hayes' view, might be reluctant to hold debt in a potentially weakening currency, stablecoins become the primary T-bill sink, the place to park those dollars, with sanctions being the coercive tool to ensure capital flows exactly where Besant dictates. It's a pretty stark picture.
So what does all this mean for you listening? We've taken a really deep dive into a vision of global finance that's both, well, audacious and potentially profoundly disruptive.
Yeah, this author, Hayes, presents a future where stablecoins aren't just some crypto innovation. They're a strategic tool in a big geopolitical game, reshaping how nations and individuals like you interact with the dollar. It raises a really important question. If this vision, or even parts of it, plays out, how might your own relationship with money, digital or otherwise, be irrevocably altered?
Could the very apps you use every day for social connections soon become your main way of interacting with global finance? Fundamentally shifting power dynamics we've maybe taken for granted. Something to think about. That's our deep dive for today. If you found this conversation insightful, please remember to follow, like, and share this deep dive with others who are curious about the future of money. And for more perspectives and updates in this space, you can also follow What Bitcoin Taught Me on Twitter X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn. Thanks for listening.